Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Value Investing Principles, a beginner's guide to building long-term wealth. Value investing is all about finding undervalued stocks and holding them for the long haul. It's a strategy built on patience, research, and the belief that real value doesn't always match market prices. Benjamin Graham, often called the father of value investing, shaped this approach with timeless principles that still guide investors today. Whether you're new to investing or looking for a proven strategy, understanding these fundamentals can help you make smarter financial decisions. What is value investing? Value investing focuses on identifying stocks that are trading for less than their true worth. It's a strategy that requires analyzing a company's financials, understanding its business model, and comparing its current price to its potential value. Instead of chasing trends or hype, value investors aim to buy solid businesses that are temporarily undervalued by the market. By using this approach, you're essentially looking to invest in opportunities where the market hasn't fully recognized a company's potential. Done right, the rewards can be significant, but it takes patience, careful research, and the ability to think independently. The core concept: intrinsic value. At the heart of value investing lies intrinsic value, a stock's true worth based on its fundamentals, not its current market price. Think of it like buying a car. Would you pay the sticker price, or would you assess its actual value based on the condition, mileage, and features? That's how intrinsic value works. Some factors used to estimate intrinsic value include earnings potential, assets and liabilities, balance sheet strength, cash flow, growth prospects. Market value, on the other hand, reflects the price buyers and sellers agree on at a given moment. But the market doesn't always get it right. It's often influenced by emotions, speculation, and short-term news. Value investing is about separating noise from facts. When intrinsic value is higher than the market price, it could signal an opportunity. You're aiming to buy quality at a discount. Key attributes of value investing. Value investing isn't just about crunching numbers, it's a mindset. These are the core traits that set it apart. Patience. Value investing takes time. Stock prices may not rise overnight, and you'll need the discipline to wait years for the market to recognize a stock's value. Instant gratification isn't part of this strategy. Discipline. Sticking to principles is critical. Markets are unpredictable, and it's easy to be swayed by hype or fear. Value investors rely on their research, trust the process, and avoid emotional decisions. Risk aversion. Unlike aggressive strategies that chase high returns with high risk, value investing is focused on minimizing downside. It's about buying stocks with a strong margin of safety, meaning there's a built-in cushion between the stock's price and its intrinsic value. If things don't go as planned, this margin reduces potential losses. By mastering these qualities, you'll be well equipped to sidestep the hysteria of market cycles and maintain clarity in your decisions. Value investing isn't flashy, but its principles can help you build wealth steadily over time. The legacy of Benjamin Graham. Benjamin Graham is often credited as the pioneer of value investing. His approach to the market wasn't just about picking stocks, it was a philosophy grounded in rationality and discipline. Graham believed that investing should be methodical and focused on protecting capital, rather than gambling on short-term market movements. His teachings have influenced countless investors, including legendary figures like Warren Buffett, who once described him as the second most important influence in his life after his own father. Through his books and principles, Graham laid the foundation for a timeless strategy that still drives the decisions of investors today. The Intelligent Investor. Key lessons. Graham's book The Intelligent Investor is widely regarded as the Bible of value investing. It's not a guide to getting rich quickly but rather a manual for building wealth steadily and sensibly. Here are some of its most important takeaways. Investing versus speculating. Graham drew a clear line between investing and speculating. Investing means thoroughly analyzing a company, understanding its fundamentals, and focusing on long-term gains. Speculating, on the other hand, is akin to gambling, betting on price movements without solid analysis. Graham emphasized that serious investors must prioritize knowledge over emotion. The importance of Mr. Market. Graham introduced the concept of Mr. Market as a metaphor for the stock market. Mr. Market shows up every day offering to buy or sell stocks, often at illogical prices based on mood swings. The lesson? Don't let the market's irrational behavior influence you. Instead, use it to your advantage by buying undervalued stocks or holding firm when others panic. Focus on intrinsic value. According to Graham, every stock has an intrinsic value, its real worth, based on factors like income, growth potential, and assets. The goal is to buy when the market price is below the intrinsic value, creating an opportunity for profit when the market eventually corrects itself. Emotional control. Successful investing requires a cool head. Fear and greed can derail even the best strategies. Graham stressed the importance of maintaining emotional discipline, especially during market fluctuations. This is a skill that separates great investors from the rest. Margin of safety, a foundational principle. The margin of safety is central to Graham's teachings and is often considered the bedrock of value investing. It's a straightforward yet powerful concept. Always leave room for error by buying assets at a price significantly lower than their intrinsic value. What it means. Think of the margin of safety as a built-in cushion. Imagine walking a tightrope with a safety net underneath. That net doesn't guarantee success, but it lowers the risk of a catastrophic fall. In investing, this safety net is the gap between what you pay for a stock and its true value. Why it's important. No valuation method is perfect. Calculating a company's intrinsic value involves assumptions, and those assumptions can be wrong. A strong margin of safety helps offset mistakes, ensuring that even if your analysis isn't flawless, your downside risk is limited. How to use it. The margin of safety isn't about eliminating risk altogether, it's about managing it. Graham advised buying stocks with enough margin so that even in a worst-case scenario, you don't lose. Whether it's a sudden downturn in the company's performance or an economic crisis, this buffer can make a huge difference in preserving your capital. By adhering to this principle, investors can prioritize long-term sustainability over short-term gains. For Graham, investing without a margin of safety was like driving without insurance, an unnecessary risk that could be avoided. Through these lessons, Benjamin Graham's principles continue to guide smart, methodical investors. His emphasis on discipline, intrinsic value, and safety serves as a roadmap for navigating the ever-changing stock market. Key principles of value investing. Value investing is a methodical, common-sense strategy rooted in patience and discipline. It focuses on buying stocks at a discount to their true worth, providing both safety and opportunity. Below are 3 key principles that every aspiring value investor should understand and implement. Focusing on undervalued stocks. Value investing starts with finding undervalued stocks, companies trading for less than their intrinsic value. But how do you spot them? It's not about guesswork or luck, it's about research and analysis. Here's how to start. Look beyond popular stocks. Ignore flashy stocks that dominate headlines. Instead, search for quality companies overshadowed by market noise. These hidden gems often have strong fundamentals but get overlooked. Scrutinize financial statements. Pay attention to key metrics like price to earnings, P/E ratio, price to book, P/B ratio, and free cash flow. A low P/E ratio can suggest a stock is undervalued compared to its earnings. Understand the business. Do you understand how the company makes money? Look for businesses with a clear, stable model that you can explain in simple terms. Avoid overpaying. A bargain price isn't enough, it must come with strong financial health. A low price means nothing without tangible value to back it up. Investing in undervalued stocks is similar to bargain shopping. Just as you wouldn't pay full price for an item when it's marked down, value investors aim to buy into solid businesses when the market underestimates them. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.